Okay, we're moving into Chapter 5, and in Chapter 5 we're continuing to look at intercompany transactions, and specifically in Chapter 5 we're looking at financing options that might occur between the parent and the sub, specifically bonds and leases, because those are common transactions that the two parties engage in. So we're going to start off by looking at Exercise 8, which is a direct financing lease option. And if you look in your book, Trailer is an 80% owned sub of Parker, and there's a 4-year lease that is occurring between the parent and the sub, requiring $12,000 payment on January 1st, with title transferring at the end of the lease. This first part is review of intermediate, if you recall that with leases they can be either operating or capital. If the title transfers, it means it's a capital lease, and therefore we treat it as though it's a purchase with financing. So you'll see here on the screen that I have an amortization table set up, and we're going to start off filling that in. So our initial balance given in the book is a lease for $40,822. The payments are $12,000 for 4 periods, with the first payment, you'll note, coming right at the inception of the lease. So the initial payment is all principal, and it goes to reducing the principal balance. After that, then, our payments are going to be a portion principal and a portion interest. Interest rate here is stated as 12%. So our interest for the first one is $34.59 based on the principal balance at 12%, which means then that the remaining payment, $85.41, is principal, and our remaining principal balance is $20,281. This, as I said, should be review of intermediate. We're going to take those and copy those formulas down. And you'll see that the balance then at the end of the lease is 0, like it should be. And these are the things we're going to use for our worksheet entries. So the table itself is review, but now we'll get to the new material for consolidation purposes. Again, on the worksheet we have to eliminate things that happen between the entities because it's not with an outside party, and therefore it's not a gap transaction. Looking again at the inside cover of your text, you'll see there's 3 entries related to leases, CL1, 2, and 3. The first one is to reverse the revenue and expense, because if it's a loan, there's revenue earned by the lessor, expense paid by the lessee, and we just need to reverse that because it happened internally. So we're looking at the worksheet entries for 12/31/11. This $34.59, while it's paid on 1/1/2012, obviously has all been accrued for the prior year, so it should have been included on the trial balance of both the parent and the sub as an accrual entry, and we're just going to eliminate that. Then we also have to eliminate that intercompany actual principal obligation as well as receivable that would be on the books. So this is like the payable, this is the equivalent of the receivable. And the obligation is going to be what's still outstanding based on our table. So we're going to take that as our reduction of the obligation. The interest payable we just talked about was accrued for our interest expense and interest revenue. And our unearned interest then is the combination of what's left for the remaining 2 payments. And the balance of all of those is the remaining 3 payments, 12, 13, and 14. That's the receivable. And those all go back to intermediate in terms, if you remember, the receivable is the total payment, the obligation is broken down between principal and interest. So that's just taking the receivable and payable off the books in essence. So we have adjusted for the revenue and expense of interest, the balance sheet for the payable and the receivable. The last entry is to reclass the asset, and we need to just adjust that so that it reflects the fact that it's being used in production, that it's a productive asset. So we're going to reclass that from equipment under a lease to productive, and then we also need to reflect the amortization or depreciation of that leased asset. And in this case, if we take our total asset value, in the book you see that it has a 5-year life. That's our depreciable amount. And those are our entries then for 2011. When we get to 2012, follows the same principle. We go back to the table to update our amounts. So we see for 2012, the interest that would have been accrued by both parties is what's going to be due on 1/1/2013, or $24.34. The remaining balance that is outstanding is this $20,281. So we're going to record that as the payable. The interest we just looked at. The unearned that remains then at this point is only the last payment amount. And our minimum lease payments are the remaining two for 2013 and 2014. The entry to reclass, the asset still is the same. Only difference in this entry is that we now have 2 years of depreciation. So we're going to take it at that amount because remember, accumulated continues to increase for each year. And on the worksheet, we don't have any general ledger. We have to account for prior years. So that's why we've got the 2 years there.